everyone. This is Amit Pabari, founder and managing director of CR Forex. In today's presentation, we are going to discuss three things: why forward premiums are falling and what is the impact of it. Second, outlook of rupee, and third, strategy for exporters and importers. Forward premiums are trading at 11-year low, as you can see in the presentation that from 1st November till 18 November, forward premiums have fallen by 35 paisa or close to 0.21%. Now let us understand why it has fallen. Forward premiums are nothing but interest rate difference between Indian bond and US bond. In 2022, US have increased interest rate by 375 basis point and India have increased interest rate by 190 basis point. Now, last week, Indian inflation came much lower than expectation. So market has started building an expectation that US will be aggressive in increasing the interest rate while India will not be. Because of that, interest rate differential between two countries has reduced. Second reason is arbitrage between Indian bank onshore market and offshore market has reduced in last 7-8 trading session, which is creating more pressure on forward premium. But the most important point is what is the impact of falling forward premiums on exporters and importers. Let us start with exporters. Exporters are having double-edged sword currently because rupee has strengthened from 83 to 80.50 level and forward premium have also fallen. Now, the important point to note for any exporter is that if they are booking for a longer period of time, say 1 year, the key is that there is no harm in booking for a longer period of time, but they have to ensure that they pre-utilize the forward when rupee is appreciating. Any unutilized forward can be a dangerous kind of situation for an exporter who is keeping the forward for a longer period of time, as the premiums have come down and we are living in a world which is full of volatility. For importers, it is an advantageous situation as they can hedge for a longer period of time. Now let us discuss outlook for rupee. As discussed in our last two videos, that 80.50 will act as a strong support and the pair is expected to bounce towards 81.50 to 82 kind of a level, and exactly the same has happened. In coming days, we recommend to all exporters that any uptick towards 81.5 to 82 should be taken as an opportunity to sell rupee and increase their hedge ratio. Now let us understand why. First reason is that in last 1 week, crude oil has fallen by 8%. Second, FIIs are continuously investing in Indian equity market and there is a talk that MSCI rebalancing fund flows are expected. Third, dollar index continues to trade below its strong resistance of 109.50 and hence any uptick to be sold. Now let us discuss strategy for exporters and importers. Let us start with strategy for thin margin exporters like chemical exporter or an agri exporters. They are taking costing between 81 to 81.25. Currently, they should follow 100% back-to-back hedging policy. Levels between 81.50 to 81.90 are good levels for them to move towards 100% hedge ratio. Now let us discuss strategy for thick margin exporters. Thick margin exporters like textile exporter or engineering exporters, as we are expecting the dollar index has topped out for some time as of now, and rupee has also topped out at 83 kind of a level. Any uptick towards 81.70 to 82 levels should be used as an opportunity to increase the hedge ratio from 45% to 50%. Now let us discuss strategy for importers. We have advised importers to hedge between 80.50 to 80.80 kind of a level. If any importer who has missed buying at those levels, they can keep a stop loss of 81.90 and 82.20 for covering their imports for a target of 81.10 to 81.20 kind of a level. With this, I will end my today's presentation. Jai Hind, Namaskar, फिर मिलेंगे Wednesday को.